Hello, everyone. Thanks for tuning into Smart Monday's investment update for July 2020. I'll take you through a quick disclaimer. Basically, this is just a reminder that everything we talk about today does not take your personal financial circumstances into account and is general in nature. Please seek more information from a financial advisor or give one of our smart coaches a call before making an important decision for you. Okay, so I'm Shannon O'Shea. I'm the head of member and corporate services at Smart Monday. I'm joined today by Ed Tomlinson, Aon's head of investments in the Pacific region. Hi, Ed.
Hi, Shannon.
Okay, so Ed, as usual, I'm here today as the voice of our membership and our clients to ask you some of the curly and common queries we are hearing and make sure we keep it simple without any tricky financial jargon, if that's okay. If you could give us a little bit of a recap, what's happened, especially in the last financial quarter, and also what's happening in the market at the moment. Our members are wanting to know how we're doing and what's going on.
Sure. So markets have been moving a lot this year, and that's pretty much what we've talked about in most of our recent updates. The March quarter resulted in one of the fastest falls in history, and falls of this size are typically referred to as a bear market. That direction reversed in the next quarter, with markets recovering at an extraordinary pace. There was a real stellar move out there with the US, where the S&P 500 index posted its largest 50-day advance ever.
Wow, that sounds like a really big day for the US index there, Ed. I have another question on the bear market. We often hear the term bear and bull used. I've got a theory around bears going into a cave, and therefore that might mean it's a bad financial time in the market, and bulls charging, therefore it describes a positive financial market. Have I got that right, or why do we use bear and bull?
Oh, Shannon, that's a great analogy. There's also another way of looking at it, and what I understand is that it's to do with the way the animal attacks its prey or its foe. Look, regardless of what is the right metaphor to look at and talk about, what we really want, and what I'm sure all members want, is those bull markets to keep coming, because that's when returns are going up, and those bears to stay hibernating and away in the dark where that is a market that's going down. So let's go the bulls and just avoid those bears if we can.
Okay, that's great. Thanks for clearing that up. There's also another couple of terms that are a bit newer that have started to pop up. A term I'm hearing is swoosh, or the letter V or the letter W to describe the market and what's actually happening. Can you unravel that for us as well?
Yeah, all these terms are really views as to what might happen next, and a V or a W is being used to describe the way the economy might move up or down next. So a V suggests a fast recovery, and the W suggests a second or maybe several drops before we really get going. The swoosh, just like the Nike logo, suggests that after an economic fall, a long, large recovery could follow. While stock market returns across the past quarter really do indeed give the impression that the economic swoosh could happen, I think the economy may not follow this pattern. The new normal that we're moving towards, I think it's not really clear just yet, and some reasons to be cautious have surfaced recently, such as surging infections in the US and closer to home in Victoria.
Yeah, look, I'm in Melbourne and the news on the virus front here is quite somber, but we're doing our best to keep our chin up, Ed.
Yeah, look, I'm glad I'm in Sydney. We all have to be careful to avoid further restrictions, but I really feel for you guys. Look, despite my view, there's still a substantial amount of government stimulus in place, and this can provide positive economic momentum. This does make me cautiously optimistic that the lows we experienced in March may not be tested again.
Okay, so you did mention the government stimulus in our last update as well. Why is it important? May you please recap?
Yeah, look, it's really important actually. Governments have been supporting their economies with initiatives designed to keep companies afloat and put money in the pockets of affected employees. Keeping companies operating and consumers buying helps keep the economy moving. And JobKeeper and now JobKeeper 2 are great examples of these initiatives. The Australian economy just isn't yet able to support itself, and that's why it was important for JobKeeper to be extended. Secondly, the RBA buying bonds during the crisis sent a really strong signal backed by big bucks that the government is ready to do what's necessary to keep investment markets functioning. Other central banks continue to intervene in markets. And here the big news has been the US Federal Reserve Bank buying new types of securities in an effort to keep bond markets functioning properly.
Okay, thanks for explaining how that fits in, Ed. So look, the one I've been waiting for is how did Smart Monday perform against our peers in the local market?
Sure. So look, as it's the time of the year when we all get our annual statements, I'm going to start by confirming that most members will achieve a slight positive or a slight negative result for the financial year. And this really isn't surprising given the COVID crisis and what it's done to markets. But despite 2020 and all its surprises, we remain happy with the overall results. Smart Monday has a great investment strategy and its life cycle approach has served members well over the long term. The chart you can see on the screen shows 3-year returns of one of our 40-year-old members, which is approximately the average age of members in MySuper. The first bar in the 3-year return is to September 2018, so quite a bit of time ago. And then as we move all the way to the right, we get to the most recent 3-year return. And the point I take away from this is despite a really, really difficult 2020, the long-term returns are still attractive. Also note the difference in the blue and the gray bars. Throughout the entire period, this member has achieved better results than the average super fund, which is shown in gray. This really demonstrates the value of having a long-term investment plan and sticking to it.
Excellent. I love those blue bars, Ed. So because I'm keen on what's happening at other super funds, I'm noticing, and some of our members have asked, why have some super funds posted a positive return and there are other super funds with very large losses? Can you explain why there is such a broad range of performance results between super funds?
Sure, and there's lots of factors here, so I'm just going to focus on 2 important ones. And the first one is how much of that super fund was invested in growth assets. And that really does matter because during the crisis, higher exposure to many growth assets, shares as an example, has provided for lower returns so far. And even though there's been a great share market rally since March, these assets are still down. And then there are investments in assets which are valued periodically. Some super funds have a very large exposure to what's called alternative investments, and often such investments are valued infrequently, which can be an advantage when markets fall quickly, as the valuation takes a little bit of time to be updated. Take property as an example, and you can see this on the screen right now. I borrowed this from Chant West. They are a prominent research firm, and they recently compared property listed on the ASX with unlisted property. And they found very different short-term returns for quite similar assets. Unlisted returned minus 2.1, where listed property was a minus 20, nearly 21% for the year to 30 June. Now, firstly, there are some big differences between the different types of properties, so there should be differences in return. Take a toll road compared to a shopping mall, for example. And even though both have been impacted by the shutdown, it does have a different impact and a different size. But over the long term, the approach to valuing property should start to be less of a factor in returns. And we might just see these two returns converge.
Okay, so it's safe to say that over time, these results may even out. Is it also safe to say, Ed, that simply put, unlisted property versus listed property means it's on the share market and unlisted property is generally privately owned?
Yeah, you're absolutely correct. And the problem in the short term with really getting into the technicalities like you just have, it makes it really, really difficult to compare returns versus between super funds. And that's really why we encourage members to focus on long-term results when comparing funds, because that should mean that these technicalities just move to the side.
Okay, so as you always say, Ed, it's time in the fund, not timing the fund, which is why it's important to look at long-term returns when you're comparing or when anyone's comparing a super fund. The statement I'll read out now comes from Super Ratings Fund Crediting Rate Survey that was published in June 2020. And the facts state most members invested in Smart Monday MySuper have achieved long-term returns that are amongst the best 25% of comparable super funds. So that's exciting and also aligned with the investment strategy that you talked about earlier, Ed. So thanks so much for making that clear. Just to help maybe some of the different age categories that we have in our membership. Our younger members would have different results to our Thursday, Friday members that are a bit closer to retirement. And this is a little bit different in the market as far as the default investment strategy. Can you please remind our members how this MySuper life cycle approach works for Smart Monday members, please?
Our life cycle approach is designed to give the best of both worlds. On one side, to give great returns, but as also on the other side, when members need it, protect their balances. And I'm going to use this chart to explain it. And when members are starting out their superannuation journey, on the very left, you can see Monday and people who are under the age of 20, they invest a higher exposure to growth assets. And you can see this with the blue line being very, very high. That's the exposure to growth assets. And having a portfolio of that type gives members the opportunity to earn great returns, but it also does mean that they're taking on more risk. But they can do that because they have quite a long time until they get to their retirement goal. As we move across to the right, as members start to mature, perhaps they're thinking about what their retirement's going to be, or maybe they're even just about to retire. What the strategy does is make sure that the exposure to growth assets falls, and falls in such a manner that their protection increases a lot. So a member who is 65, 70, or somewhere in that age bracket is really in good shape. And we can see that with the returns across this crisis. They've been through a difficult point in time in terms of markets and results, and their portfolios have really stood up, and their returns are amongst the best in the market. What I take away from it is that the way it was designed was to manage this risk through a member's life. And it was designed in context of what could go wrong. So we didn't, of course, know that there was going to be a virus or a crisis happening in 2020, but we did know that crises do happen regularly. And it was built really to give older members, someone who's just about to retire, the opportunity to still have a great retirement, even though crises happen. So in short, it gives you those great results when you're young, it protects you when you're a little bit older, and it really takes into account the fact that crises can and do happen.
Great. So thank you so much, Ed, for breaking that down. And thanks again for your time and for making it so easy for our listeners to understand.
Thanks, Shannon.
My pleasure. As a reminder to everyone listening that if you're thinking about your super and have any questions about your investments, the best place to start is by getting in touch with our Smart Coach team. So I'll put their details up on the screen now for you to take away, but you can always head to the website or you can email them at smartcoach@smartmonday.com.au. Ed, thanks again for your time, and everyone have a great day.